You finally have some money working for you, and the second you need it, the CRA is waiting with their hands out. You sell an investment, there is capital gains. You pull from your RRSP immediate withholding tax. Even in retirement, extra withdrawals can push you into a higher tax bracket. Now, what if you could access tens of thousands, even hundreds of thousands from an asset you already own without triggering a tax bill? In this video, I'll show you how policy loans on Canadian whole life insurance lets you do exactly that legally and predictably. Let's start with the way most Canadians access cash. When you withdraw from a non-registered investment, you pay tax on your gains. With RRSP, every dollar out is fully taxable as income. Even with TFSA, yes, withdrawals are tax-free, but you lose contribution room until the following year, so you are limiting future growth. Whole life insurance has the same issue if you treat it like a regular account. Withdrawals from your cash value are only tax-free up to your adjusted cost basis, basically what you've paid into the policy net of certain adjustments. Anything above that, CRA treats it as income. You get the money, but you also get a tax slip. So you are stuck choosing between keeping your money compounding or paying tax just to use it. Now, here is where things change. A policy loan is not a withdrawal. You are not taking money out of your policy. You are borrowing from the insurance company and they use your cash value as collateral. That sounds simple, but it's completely changing the tax treatment. Because the cash value stays inside the policy, there is no disposition, no deemed sale, no taxable event. Your coverage stays in force, your death benefit is still there, and your cash value continues to grow inside tax-sheltered environment. Most Canadian insurers will lend you a high percentage of your cash value, often somewhere in the 85 to 90% range, subject to their own rules and underwriting. The loan sits on the side as a separate line item. You can choose to pay only the interest, pay down principal, or let the interest accumulate. If you never pay it back during your lifetime, the outstanding loan plus interest simply gets deducted from the death benefits when you pass. Your beneficiaries get the remaining amount tax-free. So instead of breaking your assets to access cash and waking up CRA, you are just pledging it and keeping the engine running. The key tax rule here is straightforward. In Canada, a loan is not income. CRA doesn't tax you on borrowed money because in theory, you owe it back. That's why a mortgage, a line of credit, or a car loan isn't taxable. Policy loan on whole life insurance follows the same principle. You are borrowing against an asset, you are not cashing it out. That's completely different from a withdrawal or a partial surrender where you permanently remove money from the policy and can create taxable income above your adjusted cost basis. Legally, what's happening is a collateral assignment of the policy, not a surrender. The insurer or a bank takes a security interest in your cash value, but the policy itself keeps working. Dividends continue to be credited based on the full cash value, not what you've borrowed. The policy doesn't know it's being used as a collateral. It just keeps growing according to the contract. Major Canadian institutions understand this well. That's why banks and insurers are comfortable offering lending programs secured by whole life cash value. The cash value is stable, it doesn't fluctuate with the stock market, and it tends to increase every year under current product designs. This combination, non-taxable assets plus ongoing growth, is what makes policy loans such a powerful planning tool. So, how do you actually use this in real life? First, you want $50,000 for a down payment on a rental property. If you sell investments, you might trigger capital gain and lose future growth. Instead, you borrow $50,000 against your policy cash value. The fund comes out of a loan, not an income. You still own the investment inside your policy, and the cash value keeps compounding. Second, you are a business owner and you need $100,000 to expand operations. Pulling that from your corporation might mean extra taxable dividend or salary. If the corporation owns a participating whole life policy, it can borrow against the policy instead. No T4, no immediate corporate tax hit, and your retained earning strategy stays intact. The third one is retirement. Maybe RRSP withdrawals would push you into a higher tax bracket or reduce income tested benefits. You can use policy loans to supplement your retirement income in certain years, reducing pressure on your RRSP withdrawals. One important caution: during your accumulation years, you generally want to at least service the interest and, when possible, repay principal so you can reuse that borrowing room. Letting the loan and interest compound unchecked can eventually threaten the policy if it gets too close to the cash value. If you remember nothing else, remember this: withdrawals wake up CRA, but properly structured policy loan lets you use your cash value without creating taxable income. This works because you are borrowing, not withdrawing, so your money can keep compounding inside the policy while you use it outside. If you would like to see how this could fit your financial security plan, reach out for a personal review. And if you already own a whole life policy, let's check if you are set up to access the cash value efficiently. If you find value in this video, please subscribe and turn on the notification bell and share this so more Canadians can build tax advantage generational wealth. See you in the next video, and thanks for watching.